Are we anywhere close to a shift in direction for the dollar?
We don't see that. That's definitely our strongest held view here. We've just put out some really interesting research at what's been driving this big dollar cycle, and I cannot see the end of this dollar cycle at this point. And I just remind you, Jeff, you're absolutely right. What goes up generally does come down, particularly in mean reverting foreign exchange. But think about the Swiss franc, which we were just talking about. So for so many years, the Swiss National Bank, everyone in markets thought it would come down. It hasn't still.
Yeah, just on the Swiss, we were discussing whether the central bank's intervention has worked, whether they are threatening the market sufficiently at this point to prevent further appreciation. What do you think, Marvin?
Well, I think the more interesting thing here is that if you think about what central banks are reacting to in the world, there's two different schools of thought. One is that this is a cost shock and that central banks should look through it because actually it's going to be deflationary over the longer horizon. The other is that it's a demand shock that they need to react to. I think it's not one or the other. It's both. It depends where you're looking. In the U.S., there is much more weight on the demand shock. You have a huge capex boom going on there. That's why the Fed needs to be aggressive. Elsewhere, there's more question about that. And I think what you're going to see is more of what the Swiss National Bank did today, which is tell you, hey, we're not absolutely sure how much of this is demand, so we're going to react to it. But we are starting to get a little bit concerned about the long run effects of this. And so we are going to be watching the currency. And I do think you need to pay attention to that.
Good morning, Marvin. How do you buy, for our viewers, US equities on an interest rate hedged basis? Because you think they've got further upside in both relative and absolute terms. Difficult to accurately hedge that interest rate risk.
Yeah, well, the best way to do it is on a vol-rated basis, or using like 30-year Treasury futures, something like that. But the key point there is if you look at what's happened to earnings, we haven't seen stocks coming down over the last year on earnings. In fact, to a large extent, earnings have continued to surprise on the upside, especially in a lot of the tech-oriented industries. What has really been driving down equity prices is the same thing that's been affecting real estate prices and asset prices everywhere. You're driving up the denominator, the real interest rates you're taking the net present value from.
But so on that basis then, and I hear exactly what you're saying about they've been coming down but not on the earnings, and it's hard to disagree with that. But is that the next shoe to drop then, the earnings recession?
Well, that comes back, I think, Steve, to this point that I had just made about how much of this is cost shock and how much of this is demand shock. In the U.S., a lot more of this seems to be a cost shock, which is one of the reasons why I continue to be positive on U.S. equities, both in relative terms and in absolute terms. Now, part of that also stems from our research, looking at what drives dollar cycles. It tends to be these big innovation revolutions. We see one going on in the U.S. We see no signs of that stopping. And if you look at the past cycles, equities in the U.S. Peak both in relative and absolute terms after the dollar. So if I told you I can't see the end of the dollar rally from here, I can't see the end of the equity rally, at least on an interest rate hedge basis going forward.